Hello, welcome to the second part of our discussion of week 7 and current assets, and it's in Appendix E at the back of the book. It starts on page 764 and goes through, let me see here, the discussion goes through 769, and then we have an introductory problem that comes from these on the 771 page back here. So it's a short appendix, it's at the back, but it's one more, actually 3 more current assets you need to know, but really one more current asset and three investments that you need to know. The others can be considered long-term. So I have this slide behind me because it's about revenue recognition, and the main point in studying these investments are because of the revenue that they generate for the company. So therefore, while don't look at the event particulars behind it, just look at the title, because I didn't have a slide. There isn't a PowerPoint presentation for the appendices, so but revenue recognition is the main theme of what we are going to be talking about in Appendix E. Now, it's called Accounting for Securities and Investment Securities. And investment securities are this condition. Companies have excess cash that's on hand that's beyond what they need for their working capital. They do not want that cash to sit idle. They want that cash to be working for them and earning for them. So this creates a phenomenon that we call institutional investors. These are these businesses that have cash on hand, and as an institution they want to invest their money. Now, there are a lot of individuals around the world who invest as well, but the magnitude of our individual investments are not what we're talking about in Chapter 7 with current assets. The magnitude of what we're talking about here in current assets are the banks, insurance companies, even operating companies, Nike and Gateway and Dell Computers. They have cash throughout their life cycle, and especially throughout any one operating cycle, that they are going to need in the future, but they need it to be earning for them right now and not sitting idle. So they use investment securities. And investment securities, the Financial Accounting Standards Board has given 3 categories of investment securities. And they're introduced to you on page 764, and so I know this is pretty dense reading. It's much more dense reading than what the rest of the book is. It doesn't have all the pictures and the stories, but it's worth taking the time to read through them, learning these terms. I'm going to guess that when you get to finance, you will be talking about companies making investments, and that you will have to be doing returns on these investments, and you'll have to be calculating the interest to know how much the investment is earning. You'll have to know where that interest is being reported in the financial statements. Now, those professors are going to be willing to remind you, but this is your first introduction to them, so therefore it's worth the work to get through this more dense reading. There are 3 types of investments, and let me just back up from that first. Investments come in 2 forms. That's where I should start. There are debt securities, and that's when these institutional investors or individuals buy debt from another business. So they buy that business's bonds. They buy that interest notes. They take a certificate of deposit with that company. So as we think about, we think first generally about, we say stocks and bonds. It's just stocks and bonds. That's what we talk about with investments. You'll hear that term over and over again. You need to know that those debt securities have an expanded title. They could be notes receivable instead of bonds receivable, but a bond is just a more formal type of a note, and generally a larger amount. But those are debt securities. They also have equity securities, and that's when these investors buy stocks in another company. So they could be buying bonds in the company, they could be buying stocks in the company, they could be taking a note receivable from the company. So as we in a time in the future, we'll be towards the end of the semester, actually we'll be studying equities, and you'll find out that there are more than one category of equity. We've been talking about common stock, but they could also be buying preferred stock or classifications of stocks. So you just need to know that there are debt securities that could be current assets, and that meant I bought your debt. There could be investment securities, there could be equity securities, and that meant I bought your stock in some form. Now the book goes on to tell you that the primary market is when the company wants to issue its, when the selling company wants to issue its stock or its bond the first time in the market. And in that first time, just that first transaction, when the stock or the bond is sold, that's called the primary market, and that's the first time that the stock or bond is sold, I'm sorry. And then the secondary market is where the most transaction happens, and the secondary market is when subsequent investors come into the market and say, I want to buy some stock of this company, or I want to buy a bond of that company. And then the brokers find somebody who's selling that stock or that bond, and they match up a buyer and a seller, but the parent company that issued it is not involved at all. The original issuing company is not getting any interest in that. There's no activity that relates to the parent company, the issuing company, when you're working in the secondary markets. And what we see on the newspaper of what NASDAQ was doing last night, or what the New York Exchange was doing last night, those are secondary. Those are primarily secondary markets. Initial offerings go through there as well, but those are not as common as secondary offerings. So when you're looking at a stock and you're having to value it and look in the New York Stock Exchange online, or in the Wall Street Journal or someplace, and today we get most of our information online, you'll be seeing the price of the stock as it closed that day on the market. You can get it momentarily, what it is at this moment in time, and if you need to go back and value it, you'll find what it was at that day and time. Now, there are three categories, as I tried to say earlier, of these securities, and the names of them are held to maturity, trading securities, and available for sale. Now, the reason that there are those three categories is that management of the investing company, the management who is taking their excess cash and wanting to make this investment in a current asset, they have different intents of what they're doing with their cash. And so based on what management's intent is for that investment, it'll be held in one of these three categories. So let me just explain them to you a bit, and then of course it's worth reading through to see more in depth. Held to maturity means that I've made an investment, it's a long-term investment, I'm holding on to it until the note matures in 10 years, or the bond matures in 30 years or 20 years, or whatever the life of the bond is. I'm going to hold on to it until it matures, and it's a long-term investment for me. You could buy stocks with the idea of holding those long-term as well, and management, while they don't mature, still management's intent is to hold on to them as a long-term investment. Now, in the long-term assets, we'll be seeing some of these sorts of equities, those held to investment. The available for sale is the medium range of investment, and management is holding, they're available for sale if they have to sell them. They don't want to sell them right away. They might have, the investing company may be planning on building a new building 3 years down the road, and they're trying to save up money for that building activity. And so these are available for sale if we have to sell them, but this is an investment we're making to try to earn more money than we're savings, and they're available for sale, but we don't want to sell them. And then finally, our trading securities, and those are classic money market accounts where they're just taking their checking account and investing it every minute, and investing it over the weekends and overnight and all the rest to try to take whatever money is in their cash account and keep it invested. They might also be doing all but a certain amount of their cash account that's on hand, and that would be being invested in a money market. And if they had to sell, it would automatically sell. If their cash gets short, they'll automatically sell out of that trading securities and then put it over into the cash account. Now, as we think about those, you can see how management has distinct purposeful intents about this money. They're not just taking the enterprise's money and randomly investing it hither and yon. What they're doing is they're purposefully, intentionally saying, this is the checking account, we're just investing it, and it's going to be invested continuously. These are the ones that we're going to hold on to try to make money on our money, but we know that they're available for sale, and at some point we're going to have to sell them because we're going to do whatever project we have in mind. And then the held to maturity are the long-term final investments. Now, management tells the accountant what type of investment this is. The accountant, that's the professional accountant in-house to the firm, has a professional responsibility to hold management accountable for these generally accepted accounting practices, and management understands that. Management knows that they're going to be audited, so the professional accountant that's inside the enterprise might say to them, this is really an available for sale, and I think that's where we ought to categorize it and list it right now. Or they might even talk it over with the CPA at the time of the transaction to say, we're having some discussion and it seems to us like it would be this way or that way, and can you give us a confirming interpretation? And so that between management and the representative accountants, they try to use their internal accountants as much as possible, listen to them, I believe, but that's how the decision is made. Now, those are described to you on the top of page 765, and then they talk to you at the bottom of page 765 about these securities are classified according to these three categories and how they're impacted on the statement of change in cash. So they tell you that trading securities are short-term assets that are regularly traded for the purpose of producing income. Cash flows from the purchases or sale of trading securities are in the operating cash, the operating activities. So because that's just your normal routine, keep my checking account invested, that's in operating cash. The other two, the held to maturity, then are reported in the investing activities, because those are truly investments for the available for sale and the held to maturity. So you want to know that there is that distinction. There are going to be some other distinctions too, but you want to think about this short term, just keep my checking account, it's just normal operations, this is the way I earn my money. Those are operating activities. But the held to maturity, the available for sale, the I'm going to hang on to these for a couple of years, those are investments, longer term. I want those to be showing up as an earnings, a long-term earnings. And when we get to studying these more, you'll begin to see that there are some refinements that come up the generally accepted accounting principle that what I call the FASB board, has set aside. So on page 765, they talk about this investment, and they don't actually show it as a journal entry. They only show it as the net effect on the income statement. So when you turn the page to 766, the example is broken out here. Any of these, the debit would be to securities and the credit would be to cash, but it would be securities held to maturity, securities, trading securities, securities available for sale. Whichever one you made that investment, that impact is shown here. And so it would be a debit to that asset, the securities, and a credit to your cash, because your cash is going out to buy that investment. And then the next thing that they have here is to recognize the revenue off the investment. And the first one they have is they earned $1,600 of cash investment revenue. So that would be like the interest on the loan or the interest on the bonds or a dividend from the stock. Any of those are realized revenue recognition. That's a realized income. You got that money in the bank, so they sent you that money, and you would be debiting the cash that you received for $1,600, and you would be crediting income, whatever kind of income it was, for $1,600. And the income would be interest on securities held to maturity, interest on securities, trading securities, interest on securities available for sale. So that credit to the revenue would be whichever one of these you were receiving the revenue, the interest income on them. Then in event 3, they sell some of these securities, and they sell $2,000 worth of their securities, and they sell them for $2,600. Now, if they paid $2,000 and they sell them for $2,600, there's going to be a $600 realized gain, a realized revenue recognition gain that happened on these securities. So we're going to be debiting cash for $2,600, crediting investment, and so again, crediting securities investment held to maturity, securities investment available for sale, securities investment, trading securities, whichever kind the credit will go to whichever of those you're selling. And then the gain, the realized gain of $600 will go as a gain on sale of investments, and that will be your journal entry. So transaction 3 is a realized gain because it happened outside of the firm. It was an exchange transaction, and it was realized through receiving cash and a check. So that is a realized gain. And that will be the entry whenever you have a sale. You reduce some of your securities. Now then, like any other asset, because you're holding the asset over time, there's going to be an adjusting entry for these securities at the end of your calendar or fiscal year, because you've earned some income on those, and whether it's a gain or a loss, but the value of those has changed. So there will be an adjusting entry that in the book they give you one where they went online, looked up the stock market value of your securities, and found out that they were $7,000. So they went to the Wall Street Journal online or the New York Stock Exchange or wherever they went online, they found out that the securities were worth $7,000. Now, they were worth $7,700. I remember that there was a gain in this. They were worth $7,700. Now, You bought them for 9, you sold 2, so that gives you a balance of 7,000 in the investment account. So the investment account has a balance of 7,000, but the market value right now is 7,700. So now that $700 gain that you have is an unrealized gain. It's an unrealized gain on increased price in marketable securities. Now, up until now, we have not allowed you to change the historical cost or recognize a gain on an asset. But in this case, we're going to allow it. In fact, in this case, we're going to require it. GAAP is going to say to you, these are active markets. These are independent buyers and sellers acting in their own interest and driving the price of that stock to an objective market value. So therefore, you should find all your investments at the end of the year. You should locate their market values. You should find out if your portfolio has gone up or down. And if it's gone up, you can recognize an unrealized gain. And if it's gone down, you have to recognize an unrealized loss. But you have to write an adjusting entry. Now, the whole concept of unrealized gains or losses is new to you for this chapter. And I think you need to read about it here on page 767. Think about how, if you go and look at the Wall Street Journal, it's pretty representative of what the value is. And so we can recognize this adjusting entry. So what we do is we have the following guidelines from the Financial Accounting Standards Board. If it's a held to maturity securities, we do not recognize those gains and losses because your intent is not to have a current increase on this portfolio. Your intent is to own those stocks for 20 years or own that note for 10 years. And so you're just in a holding pattern. So these changes that happen that are unrealized, you don't recognize those unrealized gains or losses on held to maturity securities because your intention is not to sell them. Your intention is to hold them to maturity. Now, some companies do disclose that information in their footnotes, and that's perfectly acceptable, but no adjusting entry. On trading securities, the adjusting entry is to debit securities to make them go up by the $700 and credit gain, and that gain will be in the income statement, and it's an unrealized gain or loss. This one happens to be a gain. It could be either way, but to recognize an unrealized gain or loss in trading securities. And that income will go in the income statement, and it will be reported in the operating activities. Now then, in the available for sale, on the other hand, available for sale securities are shown in the retained earnings. The income is shown in the retained earnings. And so it will be debit to the securities to make them go up, and then a credit to the unrealized gain or loss on available for sale securities. And that is an account that's in the retained earnings because those are long-term. Those are going to hold up from period to period. Those weren't current operations, so they're going to go in an account that's recorded in the retained earnings. So you want to recognize that in this journal entry, you have 3 possibilities of what the adjusting entry might be for securities. None recorded for held to maturity. Trade securities will be current operating income, and held to maturity, and available for sale will be in the retained earnings. So as we look at those, and then as we look at the financial statements that are presented as we look at those, that leads us to the presentation of the financial statements. And there's a very good presentation on page 768 with the held to maturity trading and available for sale, and how they show on the income statement, how they show on the balance sheet, and how they show in the statement of cash flows. They, at the end of this Appendix E on page 769, they introduce you to another concept, and that is sometimes businesses buy control of a company. Sometimes it's not just investing their cash for some reason that management has, but rather it's to buy that company. So what we have here is if you buy 50% or more of the company, you have control of the company. So therefore you would use the consolidated method and say we virtually control this company, and so you'd get a consolidated financial statement. Statements, I should say, they're all consolidated. If you own between 20 and 49% of the company, you have virtual control. So because you own enough stock to influence what would happen in that business. So then you use the equity method for your investment in those in whatever companies you own between 20 and 49%, because you've bought those for some reason. You want to have influence in that company, and so you have influence to some extent, and in some cases you have virtual control, even if not absolute control. And then below 19% or below, and there's a gray area between 20 and 25% open to management and accounting interpretation, but below 20%, you definitely have this investment in just these investment in securities, whichever one of the three you might have available for sale, held to maturity. So those count for everything. If you see the held to maturity trading securities, available for sale securities, you know that's less than 20% of the business. If it's over 25 to 49, it's on the equity method for sure. And if it's 50 or above, it's on consolidations. So what we're talking about here are current assets. So we're really talking about those trading securities that come in with Chapter 7, the available for sale and held to maturity equity method and consolidation we'll look at with long-term assets, and that will be in Chapter 8. And so this is a perfect segue for you to know about for Chapter 8. Well, that concludes my remarks in this appendix. I think it's important that you're aware of these accounts and you hear about them, that you know about this information. I really encourage you to not sell your accounting book until after you finish finance, or make sure that you have an accounting book available to you, or you're willing to go to the library when you're in finance, because you're going to need to go back and refresh on these topics in order to handle your finance assignments correctly. But thank you for listening to this presentation overview on Appendix E, and I will continue to make these videos and see you in future YouTube videos on these problems, introducing you to these topics, and then in the class assignments. Again, if you have any questions on these, I welcome emails. I welcome you coming to my office. I welcome you coming to class. However you would like to get this topic discussed. See you then.